On the morning of March 30th, 2026, three people looked at the same red screen. Lloyd was in a grocery store parking lot, phone in one hand, cold brew sweating in the cup holder, refreshing his brokerage app for the 11th time before he'd even gone inside. He sold everything at 10:22 in the morning. He knows the minute because he screenshotted it. Nadia was at work. She didn't look. Her phone buzzed twice with news alerts and she swiped them away like mosquitoes because 7 months earlier she'd written one sentence on an index card and taped it inside her desk drawer. Gwen has $300 million. Her family office called that morning. The call lasted 4 minutes. Nobody sold. By the middle of April, the market had recovered every point it lost. 2 of those 3 came out ahead, and the smallest account is in that group. Spoiler alert, none of them saw it coming. Not even the woman paid a fortune to see things coming. My name is Nick, and today I'm going to take apart the most expensive myth in personal finance, which is your quiet suspicion that rich people get a warning you don't. They don't. Nobody does. What they have instead is boring, mechanical, and mostly free, and by the end of this, you'll be able to copy about 3/4 of it. If you've ever watched your account bleed and felt like there was a room you weren't invited to, hit subscribe, because we're walking into that room right now. And I want to say something to you before we go a step further. If you've ever sold something in a panic and watched it recover 2 weeks later, you are not the idiot in this story. You'll see in a minute that you behaved better than the professionals did. If that sounds unlikely to you, good, stay right there. Let's start with what the data says, because it demolishes the premise almost immediately. Every year, the Swiss Bankub surveys single-family offices, the private investment operations of individual ultra-wealthy families. The families in the most recent report averaged $2.7 billion in net worth. If anybody gets a warning before you do, it's them. They get research you will never see. They can hire a former Treasury official purely to have opinions at them on Tuesdays. So here's what they plan to do with all that insight while you were reading headlines and wondering if you should move to cash. 59% said they'd run the exact same portfolio risk as the year before, only 35% expected to change anything at all, and when reality handed them a live test, most made no dramatic changes whatsoever. They describe their own positioning with the least exciting phrase in finance: all weather. $2.7 billion, and the plan was to sit there. Now there's counter evidence, and you should have it. Capgemini, which polls wealthy individuals rather than institutions, found cash at 26% of the average portfolio at the start of last year. A year later, it had dropped below stocks as money moved back in, so somebody was moving. But look at the direction. They didn't run to cash before a decline. They sat in cash collecting interest, got bored, and chased the market up. That is not foresight. That is what you did, with more zeros and better wallpaper. So if the best informed money on earth isn't predicting downturns, what is it actually doing? The first answer is that wealthy people mostly aren't investors in the way you and I use that word. They're owners. And that difference decides almost everything about how your March goes versus how theirs goes. Here's the number that reframes everything. The top 1% of American households hold roughly 53% of all the private business equity in this country. Not stocks, private companies. Stakes with no ticker, no price quoted every 11 seconds, and no way to sell them in a panic at 10:22 in the morning from a parking lot. And when the Richmond Fed broke down the survey of consumer finances, they found something brutal. Almost wherever you sit on that ladder, your largest asset is your house. Only in the top 1% does business ownership finally outweigh the home. So if you've wondered why your net worth never feels like theirs, that's why. Yours is a place you sleep in. Theirs is a thing that earns while they sleep. So Gwen's portfolio isn't a better version of yours. It's a different species. Nearly half of it sits in things with no continuous price and no exit button. Your portfolio, meanwhile, can be liquidated during a commercial break. And here's where the industry hands you a half-truth, so let me give you both halves. The half they tell you is that private equity holds up better in crashes. On paper, it does. In the financial crisis, the buyout market fell less than 13%, while the S&P 500 fell about 40%. The half they leave out is that private assets get valued by appraisal, not by auction. Nobody marks a regional plumbing company to market every 90 seconds, so a good chunk of that beautiful smooth line isn't less risk. It's the same risk with the volatility quietly removed from the chart. It's not that the storm was gentler over there, it's that nobody sent them a photo of the roof. But that distinction matters less than it should, because the outcome is real even if the mechanism is unflattering.